Hey guys, hope you are well. I wanted to go over a video, or I wanted to go over some intel that I've come across, or some dots that I've connected in my own mind that kind of dovetail on what we were talking about yesterday with this new paper that came out by my good buddy Chris Cole at Artemis Capital, and him talking about how a lot of the hedge fund managers, literally trillions of dollars of AUM, assets under management, are all kind of on one side of the boat when it comes to their portfolios being adjusted for the quote unquote Sharpe ratio, and how this Sharpe ratio is supposed to tell a fund manager or a potential investor the risk adjusted returns of or volatility to the downside of a fund's return. So you could have two funds and both have 10% returns, but they can be dramatically different if one fund has a maximum drawdown of 1% and the other fund has a maximum drawdown of 30%. Just think about the difference between, let's say, Bitcoin and gold. If over a 6-month period, Bitcoin and gold both go up the same percentage from one point in time to the next point in time, the Sharpe ratio for gold will most likely be much higher, because it's probably not going to have the wild swings and volatility up and down that Bitcoin has. The problem that Chris points out is that if all fund managers are making decisions based on this light, sorry about that, guys. I got to get a new light here. I bought this little light because it's portable that lights up my face, and it makes me look terrible, but so there's that. And B, it keeps going. It'll shift from like warm color to cold color to warm color to cold color. And it just shifted back to warm color. And I want it to stay there, but anyway, I've got to get a new light. So back to the topic at hand. So if all these fund managers are making decisions based on the Sharpe ratio, that means that the trillions and trillions and trillions of dollars of assets under management are all going to be on one side of the boat. Well, if everyone is on one side of the boat, that means the boat is incredibly unstable. And so that leads me to the point of discussion with this video, and that what we see when we have massive volatility in the stock market, or massive volatility in the economy or in the news, anything like that, which usually translates into volatility in the stock market. Whenever we see that to a great degree, there are two things that seem to sell off, and it's very counterintuitive. Number one is gold. And number two, although we don't have a long history of this, would be Bitcoin. And at surface level, it doesn't make sense, because you're like, okay, if the stock market is crashing, if the world is coming to an end, if asset markets are collapsing, or if assets are collapsing, then I want to own gold, or I want to own Bitcoin. I want to own something that doesn't have any counterparty risk involved. But see, that's where you got to understand the dynamics of who owns the majority of that stuff, or those assets. And if the hedge funds or the financial institutions own a significant portion of that, and they need liquidity, meaning they have to sell. They have to sell to generate cash. They don't have cash. They have to sell anything they possibly can sell. Usually that's gold. That's the only thing that people are willing to buy during those times. And there's a lot more sellers than there are buyers. Therefore, the price of gold temporarily goes down, takes a big hit. And I think you'll see this play out more with Bitcoin in the future. especially if a lot of hedge fund managers are keeping more and more of it on their balance sheet, and maybe a lot of corporations are keeping more and more of it on their balance sheet. If you have a downturn, I would expect Bitcoin to behave very similar to gold in this manner moving forward, especially the more or if it is adopted to a greater degree by hedge funds, corporations, money managers, etc. So let's get into the charts here. So first, I want to look at gold and just kind of go back in time. And let's see if I can narrow the scope of, there we go. That's what I'm looking for. Right in the middle. And most of you on this live stream right now, I'm sure, can remember back to this time when we started to get some, let's say, volatility, to say the least, in markets. No one knew what was going on with mortgage-backed securities. Remember, Ben Bernanke was telling us there's nothing to be worried about because subprime is contained to subprime and it's not going to spill over into the rest of the housing market. So nothing to see here. And then people started worrying about the banking system, and everyone was telling us that, oh, banks like Lehman Brothers and Bear Stearns, you don't have to worry about them because they've been around for 100 years. And they've withstood the Great Depression and World War II and the 1970s and all of these things. So they're a solid rock. They're built on a foundation of rock, and we shouldn't be concerned with their fortress balance sheet whatsoever. 3 days later, Lehman Brothers goes bust. That's pretty much how that one played out. And so that's happening right during this time. Now, if I didn't mention already, this chart is a chart of gold, nominal gold prices. So while things start getting a little hairy, we're up around $968 per ounce. And then when the bottom drops out of everything, I can't remember the specific timeline. I think Lehman was right around, I want to say it was the summer. I want to say it was June that Lehman collapsed, I think. And then, so what happens to the price of gold? Collapses as well. And then you have the Bear Stearns incident, we'll call it, and gold just falls out of bed down to 730. So it goes from almost 1,000 down to 730. It loses call it 25% or something like that in a matter of a few months, when most people thought the economic world was coming to an end. So, and again, you would think that gold would skyrocket during these times, and it actually collapsed. So why? Is because those entities that owned a lot of gold needed cash. They needed liquidity, and it was either sell their gold or go bust. So they only had one option. And then when the Fed came in and kind of backstopped everything and announced QE1 and then everyone thought that, okay, the banks were shored up. Okay, we don't need this liquidity anymore. Then what happens is gold is off to the races, because now the system is I don't want to say secure, but they don't need the liquidity. Let's just say that the financial system doesn't, and the financial entities don't need the liquidity. But yet the table has been set for massive amounts of monetary stimulus that sends gold to an all-time high. And now let's move on to the next chart, which is Bitcoin. And if you guys remember, back in March of 2020, gold and Bitcoin pretty much did the same thing. Now gold didn't do it to as much of to the same degree that it did back during the GFC, but that's because the Fed stepped in so quickly during the Cerveza sickness that there wasn't the need for liquidity and fire selling your gold, basically, or fire selling anything that you had to obtain the liquidity or the cash you need. It wasn't there for as long a period of time. So although you see a drop, you don't see as significant of a drop. But right here, Bitcoin, February, we're up at around 10,000. And then when it starts hitting the fan with the Cerveza sickness, at the beginning of March, now we're down to, oh my goodness, we went down by almost 50% there, didn't we? Yeah, Bitcoin went down by, it doesn't look like much because of this chart, because you've got these much higher price moves. But at the time, that Bitcoin went down by almost 50%. And even though it's got a bump up here toward the end of March, and remember the CARES Act, when they announced that, when the stock market started to rebound, let's say, that, again, I got to get my timeline right. I think that was mid-March. And that's when we went from a Fed put to a government put. I always talk about that, how the Fed came out, did announce QE infinity, and they're committing $1 trillion a day to repo and all these things. And the market still went down by 1,500 points. But then that Wednesday, the government came out, announced the CARES Act, and then the stock market reversed and started going the opposite direction. It was going down, started reversed, and started going back up. So that told me that the market now was dependent upon government spending, not so much QE. In other words, they were dependent on things that government controls instead of things that the Fed had historically been in control of. And again, not that they control much, but they do control quantitative easing, and that, including expectations policy, is about the only thing they do control. But regardless, we see Bitcoin, the bottom line here is Bitcoin behaves the same way. And if we look, at least it did back during the Cerveza sickness. And if we look, which is really the only type of quote unquote crash that we have where we've got data on Bitcoin, because it's so new. And then gold, going back to the GFC, behaves the same way. And if we had the chart looking out, we would see a minor dip, like I said, in so here you had just a very minor dip. It didn't go down much at all. And again, that's because I think that it was just so quickly that they needed that liquidity that it really didn't hit the gold market. And once that liquidity was obtained, the next thing was just trillions and trillions and trillions of stimulus spending. And that's where kind of the fundamentals kick in. It's like with gold, what happens is the underlying fundamentals usually matter. They matter like 90% of the time, or maybe less, maybe 80% of the time. But then 20% of the time, the fundamentals don't matter at all. Like it's irrelevant. And then like 2% of the time, the only thing that matters is liquidity. That's it. Nothing else matters. And if you can, and anything that you have on your balance sheet that's liquid and you can sell, you're selling. And that 2% of the time, I think, is when gold obviously, and it looks like Bitcoin may fall into that category, are going to be the asset that these large financial institutions sell temporarily. I want to point that out. Temporarily, until things get, until there's not a need for liquidity. And usually the way the liquidity problem is solved is by the Fed or the government stepping in and creating an underlying fundamental environment that behooves the price of Bitcoin or gold going even higher. So then you see a big crash, but then it goes up. And usually that's a big buying opportunity, right? But the point here that I'm trying to make with this video is we're starting to see, the market's just gone up and up and up and up and up and up and up, and fundamentally it should have crashed a long, long time ago. We all know that, but we are starting to see some cracks in the market that we have not seen since 2019, and some kind of ominous signs, if you will. And then Chris beautifully points out in his paper, and this is a dot that I never would have connected, that all of these fund managers are on one side of the boat due to making decisions almost exclusively on a Sharpe ratio for each individual asset that you own in your portfolio, and how that in and of itself can create significant volatility and significant downside risk, in which case liquidity would be a premium, in which case gold, Bitcoin would most likely collapse. And if that happens, usually once the problem is solved, I shouldn't say the problem is temporarily solved with some sort of monetary injection, that presents that buying opportunity, because Bitcoin and gold go the opposite way, which is up, and up even higher than it was before. So that's really what I wanted to point out with this video. And I think this Sharpe ratio is something we really need to think through to a greater degree, and how much it is being used by such a significant pool of capital. That is number one. Number two, I want to make sure that we all understand that gold and Bitcoin, I'd say especially Bitcoin because it's a lack of history, is by no means a panacea, to the point where whenever we have a lack of confidence in the system, it just always goes up. That's not true. That's just flat out not true. So you've got to understand this. And I'm not saying you've got to understand it because you should sell your Bitcoin or sell your gold or whatever if you're long-term bullish. I'm just saying you need to understand it. So if gold does collapse and you're sitting there scratching your head saying, why is this happening? There must be something wrong with gold, or vice versa, or the same thing, there must be something wrong with Bitcoin. No. Just as an educated investor, you say to yourself, oh, gold is collapsing because it should be collapsing right now because of the liquidity needs, not because it isn't doing what it's supposed to do. And I think that that's the main takeaway from this video. Then why hold gold? Because you hold gold because it maintains your purchasing power, wait for it, over time. Over time. Not that it can't go down, and not that it can't be overpriced, and not that it can't collapse, not that it can't do any of these things. But let me pose that question to you another way. What do you own? What asset do you own because you know it's going to go up in a straight line? I'm waiting. Go ahead and other than 1995 Ford F-250 7.3 diesels, what asset do you own? And the reason you own it is because you know it's going to go up in a straight line. It's never going to go down. It's always going to go straight up. Viagra. Very good. You guys obviously, that's a rhetorical question. You get my point. Nothing is going to do that. Nothing other than Rebel Capitalist Rebel Capitalist t-shirts. That's right. But you guys get it. So I think those are some more kind of tidbits and takeaways that I've received from Chris's awesome paper. So again, if you want to check out his paper, it's free. It's incredible that he gives these papers in this research way for free, but he does. So let me. I put in the web address yesterday. I'll do it again right now. It's Artemis. Oh, whoops. Artemis. CM capitalmanagement.com. Oh, then my light just went back to warm again, as you can probably tell. All right, so I put the web address there. You guys can download it for free. Check it out. Let me go ahead and do some shout outs here. Who do we have on the live stream? We've got Bull Dog, Mutant Rayf, Alan Zibelman, Harry Hunter, Think and Grow Rich, MMMM. Vote for Pedro. One of my favorite movies. Oh, gosh, that's got to be one of the greatest movies of all time. Napoleon Dynamite. I got, what type of skills does he have? He's got nunchuck skills. That's good. The chicks. What does he say? He likes the girls like guys with skills, like nunchuck skills and computer hacking skills and macroeconomic skills. That's what the chicks dig. That's right. Any chicks here on the live stream, go ahead and confirm that chicks dig dudes with macro skills. Maybe even more so than nunchuck skills and computer hacking skills. That's right. Dwayne Hunt, Steve Z, Sustainable Lumber Company, Rev, PGESQREDU, redo, Revs, PGs, redo. Okay. Stella Q, Girth Inertia, David Lamar, Angel Pinero, Leonardo Alberto Martinez Roman, Casey Sunshine, Aya B, Peter Frowen in the house, the Godfather, Raja, SN, or S-N, S Hall, Hunted by Bears. Wow. There we go. All right, guys, enjoy the rest of your afternoon, and I will see you on the next video. Make sure you stay tuned to the George Gammon channel tonight, where we have another awesome whiteboard video on... that's right. I just remembered. On Zoltan Pozar. That's right. The repo market guru, expert, man of mystery is back in the news with some predictions for the Wall Street Journal on some cracks that he is seeing in the repo market with these reverse repos the Fed is doing. And so I outline his entire thesis on tonight's whiteboard video. So check that out on the George Gammon channel, and we'll see you over there at 9 p.m. Eastern time. You guys enjoy the rest of your evening.